Good morning, everyone. Once again, thanks for joining today's webinar. So yes, you saw what is the topic, why goal mapping beats chasing return. So first, before we dive into the concept of goal-based investing, let's first take a quick look at where our Indian market stand, by the way, today, okay, and how this macroeconomic picture looks like. Because understanding the market backdrop helps us to connect how this short-term noise and the long-term discipline interact. And ultimately, why goal mapping gives an edge over simply chasing return. So as of now, means as of Friday, the Nifty is trading around 25,710 level. So if you look for the past few weeks, the market has shown a steady recovery after a brief consolidation phase. Right. So now when we talk about the markets like going nowhere, or we are essentially describing sets a sideways or a consolidation phase, because when you see the 1 year return for Nifty 50, it's barely some 1 to 2%. So this is perfectly normal, if I want to say, and it's actually healthy for the market because after a big rally in the last couple of years, the Nifty has taken a kind of a breather, I would say. So this consolidation allows the fundamental to catch up with the valuation. Yes, and that sets the stage for the next leg of growth. See, if you look back historically, Nifty 50 has gone through a multiple such phases. For instance, between 2015 and 2017, the index moved largely sideways before taking that big kind of a takeoff in 2018. Similarly, as you all would be aware that in 2019, 20, before the pandemic, the market was more stagnant. But long-term investors who continued their SIPs through those times ended up by benefiting immensely once the recovery began. So historically, so let's see, market may pass, but compounding doesn't stop. And that's where the goal-based investing becomes critical because it helps investors stay investor even during the flat or uncertain market. See, now let's talk about the macroeconomic picture right now. See, because that's the backbone for this market behavior. So India is kind of a more favorable macroeconomic environment right now. Even if you look, the inflation is among the lowest in several years, easing the consumer pressure. And this RBI has maintained the repo rate as per the latest MPC meeting at 5.5%, ensuring stability in the borrowing cost and supporting the growth for the economy. Also, this physical discipline also remains strong, and there was kind of a small liquidity crunch, week and back, but right now it become more comfortable zone. So a low inflation, a stable interest rate, and environment which is more comfort for the business typically supports equity valuation and business growth. It also helps investors, especially those in SIP or a long-term earning growth kind of trend peoples. So which strengthens the over the next few quarters, I would say. So as we move into this festive season, the Diwali season, we're entering into one of the most crucial consumption-driven quarters for India, I would say. So this upcoming Q2 results, which give kind of a good signal, I would say, because the GST 2.0, which was implemented in September 2022, which can have a kind of a small reflection in Q2, but the Q3 earnings are where the truly we can see the impactful things because this festive demand across sectors like auto, FMCG, and discretionary spending can be seen. And also this continued benefit from this GST compliance and the supply chain reform, we can see a good benefit in Q3. So we are already seeing a strong footfalls. Also, this improving this rural sentiment and this, of course, this credit growth all have a positive indicators for this corporate earnings in a month ahead. So in short, while the market might appear sideways on the surface, but the foundation underneath is so strong. Now, this is where investor psychology becomes very interesting. When market don't move much, many investors get impatient. They start to feel like nothing happening and begin switching funds, redeeming their SIPs, or chasing short-term trends. But that's exactly the mistake we want to avoid. See, the sideways market are where the discipline and patience create long-term winners. Goal mapping helps you to maintain that structure by connecting each investment to a purpose. You don't get distracted by the short-term moments. Okay, fine. Now that we have seen somehow the broader market is in a consolidation zone with this stable inflation, interest rate, and so it's good time to take a step back and think what really drives long-term wealth creation. Is it timing the market or is it having a clear sense of direction? Knowing why you are investing and what you are investing for. That's where the goal-based investing or goal mapping comes into the picture. Goal-based investing simply means you invest with a clear purpose. Instead of saying, I want 12% return, you say, I want to build a 25 lakhs corpus for my child's higher education, or I want 1 crore for my retirement. This shift is more profound because you stop chasing performance and start pursuing your purpose. So let's take an example. Imagine there are two investors. Investor A keeps switching funds every year, chasing the top performance. Okay. Then investor B stays in a disciplined SIP aligned investment where he has a goal of 15 years from now to reach his retirement. So 10 years later, even if investor A occasionally beats investor B in an annual return, investor B ends up creating more wealth because they stayed consistent and allowed compounding to do its work. When we talk about goal based investing, we are not talking about numbers, we are talking about life milestones. Buying a home, funding your child's education, planning a dream vacation, or achieving a financial independence. These are personal aspirations, not just financial target. See, by linking your investment directly to these milestones, you are starting to view market fluctuations so differently. A 5% fall in market won't panic you anymore because you know your goal horizon is 10 or 15 years away. And that's the kind of a mental shift from reacting to the prices to focus on progress, and is what separates disciplined investors from emotional ones. So one of the biggest mistake investors make is trying to time the market. See, wait for the perfect moment to enter or exit. So see, but the truth is even the professional fund managers struggle to do that very consistently. Because see, goal-based investing takes a burden away. When your portfolio is mapped to your goal, what matters most is that the outcome. Did you reach your education corpus on time? Did your retirement plan is on track? See, you make everything in a more progress or a more correct manner. It's not about beating the nifty every year. It's about whether your investment are beating your personal inflation and helping you to achieve what you set to do so. Yes, now that we have understood what goal-based investing, now let's explore why it's so powerful and why focusing on your goal is far more effective than chasing returns. The truth is, market will always move. They will rise, they will fall, they will go sideways. But your goals remain consistent, more constant, right? And that's the anchor you need as an investor. Every investor experience market fluctuation, like there will be years where your portfolio grows 20% and others there will be years where it barely moves or goes even to negative. If you're only focused on returns, these ups and downs can cause stress and confusion, leading to kind of more hasty decisions in a wrong time. But when you invest with a clear goal, like say funding your child's education in 2038 or saving for your retirement as 20 years from now, your short-term volatility doesn't shake your confidence. Your goal acts like a compass, guiding you through uncertainty. It keeps you calm and focused because you know what you're invested. Remember, direction matters more than speed. See, if you don't kind of, you don't need to move fast, I would say. You only need to be more steady towards your target. Here's something which you need to know. Returns without purpose doesn't bring satisfaction. Think of it like if you earn 12% return, but doesn't know what it's for, or it doesn't change your life. But if that 12% return kind of helps you to reach your dream home or you build your child's college corpus, yes, that has some meaning, right? Okay, we can take another example. Imagine if you invested 10,000 every month for 20 years. We can take a rough as 12% CAGR. That's roughly 1 crore at the end. But that 1 crore only matters if it's linked to something that gives you joy. Maybe funding a retirement or a child's future, right? Without a purpose, money is just a number. With purpose, it becomes like a progress, right? So one of the biggest enemies of wealth creation is emotional investing. We buy out of greed when markets are high. See, we sell out of fear when markets are falling, right? But goal-based investing flips that all psychology. When your investments are tied to your goals, you stop reacting emotionally because you are no longer investing based on news or market predictions. See, let's take another good example. That is the COVID example. 2020 pandemic. Many investors panicked and withdrew. But those who stayed invested, especially those aligned with the long-term goals, saw their portfolio recover and significantly. They saw it moved very good way. So that's what a goal keeps you consistency. That I want to remind you, I'm investing for something bigger than what's market movement right now. Fine. Now that we have understand why goals matter more than return. So now let's take a kind of a closer look at how the traditional approach to investing differs from a goal-based approach. Most investors in India, especially first-time investors, still follow a traditional style. But as we all see, the older mindset often limits true wealth creation. In traditional investing, the focus is almost entirely on returns. But the conversation usually begins with what's the best one right now? Which stock will you kind of will give me high return this year? Can I double my money in next 3 years? The problem here is that this approach lack more personalization. See, let's assume one size fit for all strategy. It's possible. Is it possible? A same fund, a same asset mix, or a same time horizon for everyone? No. See, we can take a kind of a two investors like a 30-year-old saving for retirement and a 40-year-old saving for child's college education. Do they have same risk appetite, same time frame, or a financial responsibility? But yet you think traditional investing often ignores this contest, right? Yes, they kind of ignore this thing. That's where the misalignment begins. Now we can see this goal-based investing right now. Here you start with like your life milestone, your child's education in 15 years, your home purchase in 5 years, your retirement in 25 years. Then you align each goal into your own investment plan, like customized by risk, time, and asset allocation. For example, a short-term goal like buying a car or emergency fund, you should keep more in liquid basis. For a medium-term a kind of goal, something you should have kind of a good balanced portfolio. Then the kind of a long term, you should like retirement, and so you should have good aggressive asset means equity mix, I would say. So this diversification by goal and time horizon creates a smoother and more purposeful journey rather than treating your portfolio as one big pot of money. So when investors move from a return first to a goal first mindset, the two major things happen. They become more disciplined because every SIP has a purpose behind it. Then they become less emotional. See, because they're not reacting to short-term market movement, but instead they track progress and they move towards their milestone. This is exactly what makes goal-based investing sustainable. It's not about chasing the best performer; it's about achieving a personal best outcome. So now that we have understood how goal-based investing gives structure to wealth creation journey. Now the next question is what's the most effective way to reach those goals? For most investors, the answer lies in a simple but more powerful tool that is SIP, Systematic Investment Plan. Uh, See, SIPs are not just about convenience, they combine the two of the most powerful forces in wealth creation, rupee cost averaging and compounding. When we think about investing, volatility often feels like an enemy, but SIPs actually turn volatility into a kind of your own ally, kind of a good friend. Yes, now see, when market falls, your SIPs buy more unit. At the same time, when the market rise, it buys fewer units. Over time, this averaging kind of it average your kind of purchase cost per unit. See, if you're investing 5,000 per month, sometimes you buy a kind of higher NAV MF, sometimes a lower. But over 10 years, your average cost stays moderate and your wealth keeps growing steady and smoothly. So that's why SIP investors often outperform lump sum kind of investors during a uh, proper market space, I would say. See, not because they time the market right, but because they stay invested consistency. So compare SIP and lump sum, the consistency is only shown through SIP, I would say. Now let's talk about compounding, often called the eighth wonder of the world, I would say. See, in the exam, so I'll give you an example. See, 5,000 per month for 10 years at 12% CAGR. Your total investment is 6 lakhs, but your wealth is generated around 12 lakhs, means 11.6 lakhs something. Now, here's where the inflation comes in. If we adjust for around 5% inflation, your real purchasing power becomes roughly 7.1 lakhs, which is very less, by the way, right? Even with the inflation, you still grown, yeah, wealth sustainable. But this happens only because of your consistency, I would say. Because see, you are beating the inflation. That's where you want to see. Suppose if you are not doing SIP and just going through some traditional way of stuff, you would have made money. But what I stated, like you, if you're not adjusted that inflation, there is no use of creating money. You just pass out the time. That's the thing, right? So it's not about doing something big once. It's about doing something small again, again, and again. That's what SIP is for. So now the best thing about SIP is that that works brilliantly during the market consolidation or this uncertain phases. Because we saw right now the Nifty is been only in the consolidation phase. It's going up, down 25,000, 24,000. It's only trading this particular range. So just like the kind of market we are in today. See it. So when others are hesitating, your SIP quietly keeps accumulating units at lower prices. And then when the next growth comes in, which is like always, yes, of course, always it's going to happen. You'll already have built a solid base that multiplies faster. This is why SIPs are called the antidote to market timing. They take the guesswork out of the investing. They remove that, by the way. Okay. So far, see, okay, fine. So far we have seen this goal matters. So now SIPs helps us to stay consistent. But here's more crucial element that determines whether your investment truly works for you. That's the asset allocation. Think of asset allocation as like an engine that powers your financial plan. It's not just about where you invest, it's about how much you allocate to each type of asset based on its goals, risk tolerance, and time horizon. The first rule for smart investing is don't put all your eggs in one basket. Means don't invest everything in a kind of a same kind of nature stuff. Markets are more cyclical. Sometimes equity performs, sometimes gold shines. We are seeing how gold is rallying right now. It's around $4,360 right now. And other times that gives a good stability. By spreading your investment kind of across multiple asset classes, you ensure that your portfolio keeps growing steadily regardless of which market phase we are in. Diversification is what helps you to beat inflation consistently. See, for example, while inflation may erode the purchasing power for your savings at around 4 to 5% a year, a well-diversified portfolio can comfortably earn between 9% to 11% over the long term, effectively growing your real wealth. So the goal here is that don't chase the top performing asset every year, but to own a kind of a balanced mix. You should know when to allocate to which asset class. That's a important thing in this particular asset allocation stuff. So we all know that Indian equity. So this are kind of a good growth engine. Kind of if you're more aggressive or a more younger investor, you should have a good portion towards equity. Of course, gold, precious metal, gold, silver. I know need talk more about gold and silver. As you see the headlines itself, gold and silver are in some other phase at this current time period. Fixed income, yes, the fixed income is something most people will ignore, but they are like a stability stuff for a portfolio. They reduce your most of your confusion and so. And yes, having a good exposure to foreign equity also is a good asset allocation strategy. So see what you're seeing right now is each has its unique role to play, like whether it's together or make your portfolio more stronger and more resilient. So see, that's what I said earlier also. So there is no one fit for all. For even it's for asset allocation also. The right mix depends entirely on your financial goal, your risk appetite, and investment timeline. It's all about aligning your investment to your personal journey, not the market's moving swings. Fine. So see, once you build your portfolio and align with your financial goals, the journey doesn't stop there. think of your portfolio like your health. You don't visit a doctor just once, but and forget about it, right? But see, you go for regular checkups to make sure that you are on the track or you're healthy. Yes, everything is fine. Similarly, your investment also needs a kind of a periodic review, like rebalancing to ensure that they continue to serve your goals more efficiently. Let's talk. Let's start like portfolio review stuff. Ideally, investors should review their portfolio annually or biannually or monthly. Why? Because over time, see, your financial situations, your goal, or even your market conditions can change. Maybe your income can be increased, or like a goal like buying a home is more approachable. This shifts require you to reaccess your investment mix, your investment theme, and so. A review helps answer these critical questions like, are my investments still aligned with my risk tolerance? See, that's the first question I would say. And the second question can be, I'm on the right track to meet my financial goal on time. That's very important. Do I need to increase or decrease or redirect of any of my SIPs? So this everything can be seen only if you have a kind of a good periodical review. Imagine an investor who started an SIP in an equity fund for a 10 years goal. After 6 years, the fund has performed well. But now the goal is just 4 years away. At this point, it might make sense to gradually move some money from your equity debt or hybrid fund to protect your gains. That's see, kind of see, lot of things will come up. So you can see some of the asset class would do really well. Sometimes this cyclical stuff they do well. So it's all about rebalancing. You should have when to rebalance your portfolio. That's very important in this particular journey of this investment. So yes, rebalancing is one of the most powerful yet more underrated tool in this particular investment journey for most people. So in a small rebalancing is something bringing your portfolio like back to your own target asset allocation. So as when we started like financial planning, like based on a risk appetite, we made a particular structure. So to make everything into that area, like booking profit in some area or having grown some area would have grown faster. So we should align that to your own particular level, which was discussed earlier. So uh, it's not like see um when see rebalancing here could be like something like it's not only about like booking profit, it's like moving from debt, equity, gold. It's you should know how this thing makes you to reduce your emotions and keep your risk appetite very low. So rebalancing is more important in that particular form. Okay, before we get deeper into the other investment strategies, now let's take a step back and talk about something more fundamental or kind of foundational one, the emergency fund. So think of it like a seat belt in a financial car journey, I would say. You hope you never need it, but it protects you when the life takes an unexpected turn. Before you begin kind of your investment, it's crucial to secure a financial base, and that's exactly what an emergency fund do for you. The first rule of wealth building is don't invest money into kind of which you might need tomorrow. See, yeah, your investment should be something like it should be a long-term goal stuff, but you have some short-term emergency and so. So there, this is the time where the emergency fund comes in. So you should have ideally 3 to 6 months of your worth of living expenses should be kept ready or a separate kind of a more liquidable asset class, I would say. So see, it could be kind of not a goal, like it's not like more goal based, it's like a the goal is to peace of mind and accessibility, you can keep like that. So let's face it, like life is more unpredictable, suddenly a job loss, medical emergency, sudden family expense. So these don't wait for the market to recover, right? So without an emergency fund, so investors often forced to redeem their investment prematurely, that we are seeing in most cases. So especially when the markets dip, that's not only locks the losses, but also breaks the compounding journey you worked so hard to build. During the COVID, we have seen investors with emergency fund could stay calm and continue their SIP, while others without that cushion, they had to sell the stocks or hem off for a low price, what they are seeing. So See, as we have seen throughout this discussion, so wealth creation is not just about chasing return, it's about structure, consistency, and more purpose, right? And this is the philosophy exactly what we follow in M2W, Milestones to Wealth. At M2W, our mission is very simple yet more powerful to empower every investor to think big and reach their first grow with confidence and clarity. So, over 10 years, we have been helping clients build wealth through a milestones based investment approach. We focus on goal instead of just returns because when investors have a roadmap, say like 5 to 1 crore, they stay focused, disciplined, and emotionally stable even during this market volatile time. So our approach is very kind of combined way, like a smart strategy. Like you're always aligned with your goals. Your risk is always we have a good risk control for your portfolio. Like your portfolio is protected from extreme market swings. So steady participation will be there. So you stay investor long enough to benefit from compounding. So M2W is just like not just theory, it's backed by experience. We have over 16 years of product research and portfolio construction expertise. Our team customized portfolio using the multi-asset and milestone-based framework. As I was discussing earlier, equities, fixed income, precious metal like gold, silver, and global assets. So the most important thing is that we ensure periodic review. As I stated earlier, so your investment evolves as you move closer to your milestone. So I'm proud to share that since 2016, we've been M2W has grown tremendously, I would say. So over 10 years, more than 1,000 crores of asset under management. We have more than 5,000 clients. So each number here isn't just like a statistic. It's represent real people achieving real milestones, buying their first home, building their child's education, or planning the kind of the upcoming retirement. So if you're more wondered, where do I start? How do I stay consistent in my investment journey? M2W is the answer. It gives you structure, clarity, and a professional team to walk beside you on your financial journey. So join M2W so you can see a good wonders. So as we reach, yes, I want to talk something about this very close to my our philosophy. How this M2W milestones to wealth. We believe wealth creation shouldn't be complicated or confusing or reserved for the privileged people. Our vision is very simple. So see, to turn your dreams into achievable milestone, you don't need to having a huge starting capital. You just need to have a right direction or start what we M2W provide. Like most people see wealth creation as a one big or a distant goal. See, but I'll become wealthy someday. That's the mindset you should have. But someday never comes like unless you break into without a clear milestone. But here at M2W, we take a long-term wealth goal. Let's say you want to build a 1 crore, we break it into a more manageable stage. Like if you start from 0 or 2 lakh, you are in the self-starter zone where your journey starts. Then at 5 lakhs, you become an achiever, someone who is seen early success. Then you move towards 10 lakhs where you are a warrior, where you stay consistent and more confident. And at 25 lakhs, you are like a sharpshooter aiming with the more precision. And at 50 lakhs, you're maestro, mastering the discipline. And finally, you will become ambassador where you reach your success, that's your 1 crore. So this framework helps every investor stay motivated because each milestone feels achievable and worth celebrating. At M2W, we learned that people don't fail because they lack money. They fail because they lack structure. So we created a system where wealth creation is simple. You don't need to understand markets deeply. You just follow a guided plan. That's what I would say. So it's a structured, very instrumental. It's kind of a link to your goal. Every milestone has a timeline, and most importantly, it's accessible to everyone. You can begin with one SIP at a time. So this approach removes fear, confusion for investors in their investment journey. Whether you're a first-time investor or an experienced one looking for a clarity, M2W ensures you to stay focused, disciplined, and emotionally steady. So again, why M2W? Because you don't just manage because see, we don't just manage money, we manage your journey. We help you to start small, stay consistent, and ultimately reach big goal. Remember, every investor who reached 1 crore started with this first SIP only. So if you are ready to take a step, MTW is here to walk beside you every milestone, every achievement, and every success. So together we make a wealth creation simple, structured, and accessible through your SAP journey, right?